going to have some fun today. I'm going to talk a little bit about blockchain and where we are, where we're going, and I'm going to try to bring it down into way more practical terms here. We've had a great day. Mark Yusko kicked off with incredible insights into where this is all going. We talked about securitizing tokens. We talked about the crypto market. So what I want to do is I want to talk about the future state and what this all means to all of us as investors. I want to give you a little perspective here, not to self-promote, but I just want to give you a perspective of my perspective. I actually started the very first financial service on the internet back in 1993 out of Carnegie Mellon. I was a Navy pilot teaching NROTC. I saw the internet happen, and I said, oh my God, this is going to change the world. I had the domain names stock.com, mutualfund.com, bank.com, and I built the very first stock quote server on the internet, first mutual fund site. I actually got the exclusive for S&P Comstock information on the internet. I went to New York. I said, hey, there's this academic network called the internet, and I want to put stock information on the internet. And the guy says, well, what is that? I said, don't worry about it. I want the exclusive. It's academic network. Don't worry about it. He said, okay. Now, I couldn't get Dow Jones, industrial average. They wouldn't give me the exclusive, but I had the exclusive for stock information and Morningstar information on the internet. And Ken over here, one of you just saw talk, he started one of the first AI companies on the internet. In fact, as you heard, the technology behind that company in U.S. District Court when he sued Google was deemed to be responsible for 20% of Google's revenue. Imagine having and being the inventor of a technology that was responsible for 20% of Google's revenue. So we've been in this space since the 90s, right, Ken? Yeah. 93. And 29-year-old fighter pilot, okay, trying to build the company on technology. I've seen this movie before. There's only one difference. It's happening way faster, because when I did my first company, I had to beg, borrow everything I could to get $500,000 in venture money. I couldn't even get an equity deal done. It was a venture debt deal. It was a convertible note. Well, where have we come? 25 years ago, this week, I did that deal. So here I am. I'm building this server. In fact, S&P called me up one day, and they said, you know you're putting real-time quotes over the internet? And I said, yeah. They said, well, you need to delay that. And I said, you're asking me to do that? I had to write the code to delay the information because they didn't have it. Anyways, I went in and pitched this guy over in Princeton. Anybody know Dan? He passed away, I think a couple years ago. And the boardroom at Merril Lynch in Princeton was the size of this room. It was huge. And all these guys, and here I'm in my 50s now. Back then I looked like I was about 15. And I go in there, and I got my suit on and my suit, and I show him the internet, and he looks over to the guy to me, and he says, nobody will ever effing trade stocks on the internet. A week later, I pitched Charles Schwab, Dave Patrick, Beth Sowie, downtown San Francisco, and he said, how much do you want, and where do I mail the check? So early times, when early technologies come out and they disrupt, what does it mean to disrupt? You don't see it coming. Okay, this guy at the top of the world did not see it coming. It's easy, right? You're the incumbent. You don't want things to change. You're happy. If you're a pioneer, you want things to change. You see where it's going. So I want to rewind a little bit because I want to put this in a little bit of perspective, because history teaches us a lot. Okay, we're all, our egos prevent us. We all believe that when something's happening to ourselves, we all think, well, man, this is the first time this ever happened. No, okay? Our egos make us believe that this is the first time something happened. Let's go back, okay, all the way back to the 15th century, the Medici Bank. COSIMO, my firm, was named after Cosimo Medici. He was the patron father of the Medici family. They invented banking. Okay, they invented banking. What they did was they created the general ledger system. They became the most widely respected family, wealthiest family in Europe. Some states, still one of the wealthiest families through their lineage. But what most people don't understand is that they also created, on top of the general ledger system, a currency, the florin, 0.54 ounces of gold. It became the most widely spread, used currency in the world. So it wasn't about just having a general ledger system, it was about having currency that was backed. Okay, so I knew that when I spend the florin, I knew that it was trusted. I knew that it was going to be 0.54 ounces, and I knew that there was a general ledger system behind it. And, you know, peer-to-peer transactions are pretty straightforward, right? If I want to buy something from you, Neil, I just say, you know, let me give you a florin. You say, okay, I give somebody that florin. Okay, and a beautiful thing about a peer-to-peer transaction is it's trusted. I know you're giving me money, you give me your car, everybody's happy. Okay, but what happens if I don't know you and we're far away? Why don't we put a ledger in the system? And in fact, the Medici Bank invented this ledger. And the ledger was really a double entry system. And all it did was keep track of things so that I could be trusted. And that's ultimately what a bank is. It's a trusted third party. The word trust is the operative word. It's trusted third party. When you don't have trust, what do? You use a bank. Now, if you look at banking today, it's pretty much the same darn thing that the Medicis did. By the way, I read an interesting article, interesting book lately, and it was about the Medici Bank. And one of the other things that the Medici Bank did, because there were a lot of banks that popped up, right? Why did the Medicis win and all the other banks fail? Does anybody know? No, what they did was they created a decentralized bank. They went to all the different city-states through Europe and went to individual owners and said, you can be part of the Medici Bank and I will give you your own control, yet I will take rent and coordination through my copy of your general ledger. So when there was an attack on a bank in a city-state, they could maintain control through a decentralized approach. How about that? Does that sound familiar? Okay, this is the 15th century, and the reason why they won was because they created a decentralized approach to banking. Anyway, let's go back to banking today. It's pretty much the same thing, right? We have this bank in the middle, and we go in, and it's centralized. There's a central body of trust, right? We trust them. We trust the bank to hold it. The problem is that when you centralize something, you open it up to attack. If I'm Mr. Robot over here, I could just dial in, I could, with one password, get into the bank, and all of a sudden I've got a lot at stake. And in fact, banks lose quite a bit of money, quite a bit of capital through fraud, through what have you, because of this, right? But it's all about who do we trust to hold that ledger? The bank. Now, what's interesting is if you think about the internet, what is the internet all about? The internet is all about, the whole concept of the internet was all about decentralization. We're going to give, instead of the New York Times, the ability to post their information in a newspaper, centralized, we're going to give every one of you the ability to publish your own content. That's what we're going to do. You guys remember personal home pages? When we were at Lycos, we bought 2 personal home pages. We became the #2 portal in the world, okay, because of traffic, because we bought all the personal home page sites, Angel Fire, all these places where people could create their home page, right? The problem is you had to know how to code. And then what happened? MySpace came out, and that was too difficult. And then what happened? Facebook came out. It's all about publishing, right? It's all about decentralized content. The second phase of the internet was about decentralized commerce. All of a sudden, anybody could sell anything. The third phase was all about putting it on a mobile phone and giving everybody access and decentralized communication, right? Now all of a sudden, so you have everything decentralized except for what? The bank. Think about it. From a pure perspective here, everything in our world today is decentralized except for one thing: the bank. So in 2009, Satoshi said, wait a minute, our trust protocols are centralized and our world is decentralized. We got to change this. And so he invented blockchain and Bitcoin to illustrate the concept of what would happen if I move trust from a centralized perspective to decentralized, and that was the blockchain. Blockchain and Bitcoin. Now, does that sound familiar? the Medici General Ledger and the florin. It's the same analogy. The only difference is that now we're added some technology, some ones and zeros to it. If you think about it, money is digital token, right? It's digital, it's ones and zeros. Well, if it's ones and zeros, I can copy it, right? I take a photo, I can copy it 1,000,000 times, right? Well, if Bitcoin is just a bunch of ones and zeros, I could just copy it. So if I could just copy it and I give my wife, or she tries to give me a token, what's to prevent her from copying it and giving Steve a copy of it, right? Ben, you want a copy too, right? Why not? We'll all get copies. What's to prevent us from copying? Well, in our world today, right, 90% of the world's money supply today is digital already. So what do? We put a bank in the middle of it to make sure that I don't copy it and double spend it. So what we're doing here is we're using a ledger. So the answer is, right, ultimately, how do we prevent trust? How do we prevent people from double spending if we get rid of the bank? Who holds the ledger? How about everybody? What if we all have a copy of the ledger in our pocket? That's what we're talking about here. So blockchain really is expected to transform money. And really, what is money? Money is just a social institution of trust. That's it. At the end of the day, it's a social institution of trust. So blockchain is going to transform money. And you can see how money has changed through time, right, over the years. Okay? And ultimately, if you really think about it, if it just transformed money, it could also transform assets, equity, ownership. And that's where this gets really, really exciting. Think about voice over IP. One of the companies that I did, Vivox, was a voice over IP. When you play Call of Duty on your Xbox and you're talking to the guy on the other end, hey, I just killed you, that was a company that I did. And what voice over IP did, okay, remember the third phase of the internet was about communication. What voice over IP did was what? It took the central system of telecom, right? The way that telecom used to work was there was what? A phone company, and that phone company connected you through a big old switch. A big old switch, okay? It was central. And what they did was they put it on the internet and they made it decentralized. Now I don't need the phone company anymore. In fact, the value of the phone company today is the endpoints. It's those towers on all the roads, okay? It's not the central switch. In fact, what they did to support themselves was they sold all the real estate of all the central switches that they had, right? And I guarantee if you go into your hometown, there's some brick building somewhere with no windows, and you're wondering, what the heck is that building? That was the central switch for the phone company that's no longer used. Okay, so voice over IP decimated the telecom world. They got smart to it really quick, and they realized that they needed to own the towers. So let's use the same analogy. Who's the central switch for money today? And what happens when you don't need a central switch anymore to connect the calls, to make the transaction, to extract those rents? Money over IP is really what this is. You've got a decentralized network. If I want to give you money and you don't want to wait 2 days for it or sell you a stock and wait 2 days for it, okay, I can do that over a blockchain and it's instant or near instant. So this is what we're talking about here is money over IP. It's a simple term, but really what it is it's about trust. It's a trust net. Just like Mark Yusko said, he coined the term. Great. It is. It is the trust net. So let's all let's come back to reality here because there's a lot of hype, a lot of excitement. I'm an investor. What do I do? How do I deal with this? This is the first pitch, maybe the second pitch of the first inning. Today, only 1% of the world, okay, 1% of the population, active, engaged population, some say 70 million, 100 million people, is using these kinds of systems and currencies, okay? That's nothing. And in fact, if you look at product diffusion theory, it took the telephone 25 years to get to 10% penetration. 10% of the population. It took them 25 years just to get to 10%. Now there's a magic number. 10% is a magic number. You want to know why? Because it's the amount of that's needed for a technology to be viable and lift off. It's like the rocket. It's on that rocket, it's on the launch pad, okay? And you know when you hear the controller say we've reached apogee or whatever, I forget what the term is, probably should know what the term is, and they know it's kind of the safe zone, that's the 10%. A tech isn't deemed viable until it gets to 10% or lifted off in 10%. I would argue that crypto is just now 10%. In fact, telephone took 25 years to get to 10% and another 39 years, okay, it's the white line, another 39 years, okay, to get to 40%, whereas smartphones in 10 years. Why? Because we live in a networked world. We're using the benefit of the internet to spread the word and the adoption. And now, because of the mobile phones connected to the internet, it's in our pocket. Things travel like wildfire. But we are in the first inning. This is a currency revolution. A currency revolution. We invested in NDAO. Why did we invest in NDAO? Bitcoin's out there, Ether's out there. I'll tell you, again, I've seen this movie before, except I was the Dan Tully. So I'm sitting in Lycos, and I get a call, and my assistant says to me, hey, we got these guys from this company called Google coming in, Sergey Brin, and I don't know what the other guy's name is, but they're coming in. Do you want to meet with them? And Ken was my CTO at the time, and I said, Ken, we got these guys from Google coming in. So they came in, and they pitched us. And Ken says to me, we have all this technology, we don't need them. We did. He sued them and won in the patents, okay? But what we didn't bank on was we had the tech debt, we had revenue, we're a public company, I couldn't move the ship. I went to Bob Davis, the CEO, and he said, are you kidding me? That'll kill our stock price, okay? So what did Google do? Google learned from everything we did wrong and did it right. Now, I was in a room recently with a bunch of tech entrepreneurs, and I asked the question, I said, how many of you believe that there will be a crypto in the top 5 of all cryptos? Okay, a new crypto in the top 5 of all cryptos in 2 years. And you know what the answer was? How many people actually put up their hand? There's probably 50 people in the room. You know how many people put up their hand? Nobody. Okay? Well, I will tell you that I have a 23-year-old son, okay, who doesn't even know who Yahoo or Lycos is. If it's early, there's a lot of learning going on, and it's naive to think that the market players of today will be the market winners in the future. Chances are they will be, but it's naive to think that nobody else could answer. So when the guys from NDAO came in, and they said, hey, look, we've looked at all of the problems, okay, with Bitcoin, 23 of which, I'm like, oh, 23, how about the 3? And we figured this out. Now, you can imagine, this was 3 years ago they came to us and said, here's what the problem was Bitcoin. I couldn't even spell Bitcoin then. So we are seeing a currency revolution, and I'm not going to go much into that, but this is, and you heard Ken talk about NDAO being a buoyant currency, okay? We're talking about, stable currencies, and personally, I don't get stable currencies, all right? If I want a stable currency, I got one. It's called the dollar, okay? If I'm an early adopter of a currency, okay, and I'm taking the risk, I want to get some kind of reward for taking that early risk. So NDAO's solution is this concept of buoyancy. And I'm not going to go into this in detail, but it has the freedom to rise. It mitigates volatility. It has an incentive to hold. It actually has a thing called interest. It's a pretty slick thing, and if you're interested in this, we can talk about it. I don't want to spend a lot of time on that. What I do want to spend time on here is that we believe at COSIMO, every fiber of our being here, and we've been all tech entrepreneurs have been in this a long time, is that blockchain really will revolutionize the world of money. And what I want to do is take a little step back and say, okay, but what about private equity? What about venture capital? Right? Because that's the world I live in, and as investors, we live in this. And we heard earlier about real estate and all of these other things. So let's talk a little bit about it. First of all, tokens are disrupting venture capital investments in startups. And there was a point in time where it was easy money for a startup. You could throw out a token out there and raise a ton of money in a microsecond. A lot of pent-up demand. But at the end of the day, it's $20 billion, which is pretty substantial. It's cooled off a lot, and it's down to reality, which is a good thing, because what's happened is that I think we kind of take a step back and say, whoa, wait a minute. We got to do this right. This works, but we got to do it right. So how do we do it right? How do we think about this? How do we think about using tokens, particularly for a fund, for instance? So if you think about venture capital, it's probably one of the most illiquid asset classes out there, right? It's a 10-year J curve, okay, where I'm making I've gotten checks from venture funds I've invested in, and I'm like, whoa, where the heck did this come from? I made this investment, 6 years ago. Oh, I guess I didn't write that off. It's a 10-year blind pool. It's illiquid, and it's, the whole promise is I'm going to invest and pay out, right, later. So that's a problem. And in fact, if you think about what blockchain can do, it solves one of the biggest issues for investors, that's illiquidity. So now all of a sudden, if I tokenize an asset, you heard about the St. Regis and Aspen, or a venture fund, I don't have a 10-year J curve anymore. I can make my investment in that fund, and as the fund is marked to market with a net asset value, I could trade it away. You could say, you know what, Rob, I don't like the cologne you're wearing, I'm out, and sell. Okay, and a buyer can come in and buy. It also promotes transparency. So blockchain solves a lot of this. So I think that 2019 really promises to be the year of the security token. You heard Chris Pilata up here talking about Templum and setting up an exchange to do this, the St. Regis and so forth. The ICOs out there was a lot of excitement. A lot of excitement about ICOs, and a lot of speculation, and a lot of democratization. Anybody could buy an ICO. How wonderful is that? So for all the positive, great things that the ICO was, it also promoted a lot of the bad things, right? Scams, lack of investor savvy, et cetera. So why not take and build on a security token? Why not do this right? And what the STO promises to do is add the appropriate regulations, controls, okay, oversight and compliance that the ICO world didn't have. And to be, straightforward here, what is a security token? It's a digital token that represents the direct economic interest in a venture. It requires licensing by the SEC. It's backed by tangible assets, and anything can be tokenized. So moving forward, what this buys us now is it creates a broader liquid market. More people can get involved. I don't need a minimum $1 million buy-in to a fund. It creates broader adoption to a larger investor base. And more importantly, lower fees and faster execution. We see regulation coming in. We talked a lot about that today. There's a continual secondary market, 24/7, 7 days a week, right? As a result, you can imagine now all of a sudden, if you've got an asset class that wasn't available to the majority of people that is, you could see a situation where there's incredible growth here. So I would say that this whole security token tsunami is coming. And I'm going to give you a couple of reasons why. I'm almost done here, so I'm up here, going on and on. But, first of all, we all want liquidity. At the end of the day, we all want liquidity. We don't want to be locked up. And in fact, it's probably one of the largest driving forces as investors. And people pay for liquidity. What this basically says is that if you take everything equal, the more liquidity you give an investor, the lower return hurdle the lower return that they require. So liquidity is a very powerful source. And when you think about it, there's hundreds, as you heard Mark Yusko say, $700 trillion, okay, in these private assets that could be tokenized. So the opportunity here in this early day is really, truly astounding. The rails are being laid, and this is probably the most important. You know, in the early days, you don't have the ability to do this. You don't have the systems to do this. You don't have the marketplaces. You don't have the technology. All of this is being put together, and very, very large. This is the picks and shovels that Mark Yusko talked about this morning. You heard Chris Pilata from Templum on one of the panels here. We're using Securities for COSIMO X. So ultimately, what happens is we're going to enter this golden age of innovation. All of a sudden, you're going to have technology and systems to allow you to do things that you never thought possible. I had somebody come to us recently, and they do renewable energy projects. And they were saying, well, what happens if I tokenize these renewable energy projects, right? And what if I take all of the data from that renewable energy project and put it on the blockchain and allow people to buy fractional ownership in energy production, okay, throughout America? That right there, that is a golden age when you're using a technology now for things that you've never thought possible because of this new technology, right? Who would have thought of Uber? You know, that's what, right? You never would, right? But now with the technology, everybody, it's mainstream. It's important to understand that security token regulations have been around for 85 years. Okay, they've been around. They're using the existing regulations, and that's key. And more transparency equals more value. As an investor, that's what we want. We invested in a company called Gecko Governance, and they are doing full fund compliance on the blockchain. A mutual fund company, a hedge fund company, crypto hedge fund company can then use that technology to put all their compliance, all their data on the blockchain for the SEC, for the regulators, and for their investors to have full access to in a locked down, protected, secure place. So all of that comes together to really create what we believe will be a very exciting time for 2019 and 2020. I just want to tell you real quick, we decided to eat our own dog food, as they say in the software business, and launch a venture fund and tokenize it. And that's what COSIMO X is. It's got liquidity, transparency, inclusivity, regulation, and it's a pretty interesting product. It's a typical venture fund, except now it's being delivered through a token. So the last slide, on an evergreen basis, that's right, which is really interesting. You know, unlike a typical fund where I got to put a bogey out there and say I'm going to raise 50 million, and I go out there and raise 50 million, the way COSIMO X works is it just, you know, as people buy in, the fund just increases in size. So it's a pretty, and it's an evergreen approach. The NAV is posted on a quarterly basis. This is really my last slide, close to last slide. I mean, one more. But I want to point this out, and again, you know, when you think about the dot-com bubble, how many players survived? Not many. Amazon, maybe, Netflix, and most didn't. It was the companies that entered after that won. It was the companies that looked at what was going on and learned from that won. And as investors, that's what we're doing. That's what we're looking for. We're inspired by what we see. We know that this is going to be massive. We can see it. So what we need to do is look at the problems of the current market and say, what needs to be fixed? How do we fix those things? And how do we invest in the entrepreneurs that are going to do that? Google was the 12th search engine. Facebook, not even close. Wasn't even in that bubble. Okay? So this is really all about learning, optimizing, and taking winner take all. Thank you.